So, our first question for today's presentation via email from Terrie and Cliff. Here's what Terrie and Cliff do now. They sell a naked put at the money in the hopes to get assigned on the position. Stock fluctuates a little bit down. The naked put obligates them to buy shares of stock. As always, of course, we should never sell a naked put on stock we wouldn't want to own. Terrie and Cliff are well aware of this. They then own the stock. They buy a protective put, potentially 90 to 100 days out in time, to protect 80% of the investment. So they're taking around a 19 to 20% risk with a low-cost put option that's 3 months to 4 months out in time. We would like to sell covered calls, but when we do, we end up buying back the calls at a loss. So what is their actual question? Well, their question was, is it the timing of when we place the order for the covered calls? Well, potentially. Remember, and we'll take a look at this in a moment, that when you sell a call, either as a covered call, unless your hope is to get assigned and earn 1 or 2% every 15 to 30 days, you're not married to the stock. When you sell that call, it is a bearish position. It is a neutral to bearish position. You don't really want the stock to move up. Now, how far out should we go for the put? Well, what we teach with our preferred radioactive trading setup, we're going at least 150 days minimum out in time on the put. We'll explain why too. Of course, our goal is to own the stock for long-term and collect the dividends. You looked at the married put and collar strategy discussion on PowerOptions, and they actually own the blueprint, the full home study course. But then they talk about that collar example using a downtrend in the stock. So what happens when there's an uptrend in the stock and the covered call is below the current price? Well, we'd want to roll the call. We'd want to look at another adjustment, and that's when you'd want to take a look at what's called income method number 2 in your blueprint. The income methods, 12 different income methods we talked about in the blueprint. Income method number 1 is selling a call against this protected structure. Income method number 2 is one of the 2 ways I might react to an income method number 1, a covered call or a collar, where the short call is now in the money. Now, Sam also offers another point, Terrie and Cliff, is that you have to make sure that you watch the support and resistance levels when you're selling calls or selling puts. Now, Sam does that mainly because he wants to keep the premium and have it expire. You might want to do the same thing, but your first step is you're selling a put to get assigned. You actually want to get assigned, and if it expires, you're okay. You'll just sell another one. I understand that. But what Sam's saying is that when he sells calls and puts, he looks for them out of the money in different structures because he's following the support and resistance to try to have that whole premium expire worthless in his favor. His positions may be related to stock ownership. They also might be related to a long straddle position or strangle position far out in time. All right, but let's get to your questions directly, and I'm actually going to take them a little bit out of order first to talk about the main structure, and then talk about our covered call issue. So how far should we go out for the put? Following the blueprint and what we do, Ernie and myself on our personal account with the married put structure, any position we start, or if we ended up getting into stock through a naked put position or exercising a long call, we're still going to look at least 150 days out. You even mentioned that you want to hold the stock long term to collect the dividend. You buy it 90 to 100 days out. Well, if you just passed a dividend, 90 days out means you might not be getting to the next X dividend with the put that you paid. So after those 90 days, if you're far out put, that was protecting 80% of your security, so might be 15% out of the money or so with a 20% risk, that might expire worthless. Now you've got to buy another put for the next 90 days. The trick is once you've selected a price, if you look at the options that would be 180 to 200 days out in time are not twice the cost. You get a lower cost per day when you buy further out in time. Yes, it's a higher cost up front, but it is a lower cost per day. Now, the reason, in addition to what we do, we use a different strike than you do, because we advocate only taking a risk of maybe around 3 to 10% or so total. After a decline on a position where I'm put the stock, I might be still risking 20% potentially, but I'd have a better protection in place with purchasing a strike that's 1 or 2 strikes in the money from the current stock price, not down below. Let's take a look at an example. On November 5th, let's say that we looked at Cree trading at 51.08. The stock was on a good run. I didn't include the stock view here, but the stock was on a pretty good run for the last 5 to 10 days, well above whatever it should have been. MACD, Bollinger Band riding that upper band above the SMA 2050 and so forth. So we think it's looking good. 17 days out, we sell today's November 22nd, 48 put for 65 cents. Max return if it expired was 1.4%. Unfortunately, the trend changed. Today it closed at 45.52. What does this mean? We didn't do anything. We did not make an adjustment. We're going to get the stock put to us. We're going to have to buy 100 shares of stock at $48. 65 cents was already deposited into our account, so our real cost basis is $47.35. Now, what Terrie and Cliff might do is look 100 days out to March expiration. I believe it was 109, 110 days out in time. And they want to protect 80% of their position. So the 40 strike put, 7 points out of the money, is going to give us a cost of 207, 208, roughly 208 I think I put in. So we've got the March 40 put against our new cost basis we were just assigned, and it's going to cost us 208. Total investment is $49.43. We're guaranteed to get $4,000 back. That's the power of the put. Even if this tanked to 35, it's not like a stop order where we put it at 40, get filled here at 35, and take a much higher risk. This is a guaranteed exit. We have a 19.1% risk. We are protecting roughly 80%, in this case, of our total cost into the position. Max profit is infinite in case we think the stock's going to recover. And, the current stock price and the break-even is just at expiration, not currently. But I want you to notice these two lines here. The blue line, of course, is our hockey stick graph at expiration. The curved red line is at the halfway point, sometime around the end of January and beginning of February. But notice how quickly it goes to almost follow that as well. Now, sure, you get the max profit up here, but it gets close to that max loss pretty well. So not quite at the max loss here, right at 40 at the halfway point. But I want you to keep that sort of thin margin between the halfway point on this March put and the expiration. Let's see here. Oh, another comment just came in from, I'm going to keep trying to look at this as I go forward. But a comment here is to collect dividend is not advisable because you get 3 to 5% and the stock drops more than 10%. It's not worth it. Yeah, so we'll talk about that in just a moment as well. Now, this is a structure that Terrie and Cliff might use. It's protected. I think the risk is too high, and I think the time frame is too short. If I was in the same situation, following what I follow with the radioactive trading techniques, I'm likely to purchase the June 50 strike put. 1 or 2 strikes in the money. The stock, remembers, at 45.52. So this is going to cost me $8.15. But it's 210 days out in time, almost twice the amount out in time. And the actual risk, think about this. The stock's at 45.52, so my put is 448 in the money. I am paying $8.15, almost 4 times the cost that Terrie and Cliff would be paying. But a lot of this is time value. 448 of it is intrinsic because I'm buying the in-the-money put. So the monetary risk comes to $5.50. That's the time value, which is only about $3.70 or so. That's the time value I'm paying in, plus the $2 or so of locked-in loss I have because my cost basis is $47.35 on a stock trading at $45.52. But my risk is only 10%. It's only half. And I have twice the amount of time. And this is a combination of intrinsic and only $3.70 of time value. Why is that important? Because our March put was only 110 days out in time. It was at the 40 strike, which was out of the money, cost $208 to $210. So I'm only paying about $1.50 more in time value or in true risk to almost double the time. Not twice the amount of the time value that's there, just that. So I'm keeping a risk at 9%, and I'm 210 days out, so I'm likely going to cross one dividend, potentially two. Oh, I'm sorry. Yeah, when you said 90 days earlier, I meant that you would maybe cross one dividend, maybe two, depending on that. I might be crossing 3 dividends, depending on the structure, potentially 4, maybe even more. Okay, so again, it depends. You know, the 90 to 100. I said that wrong. The 90 to 100, you might just be coming up on 1 quarter, where if the dividend was recently, you might not even get the next X dividend. Here I'm out 210 days. I'm likely falling at least into 1 and most likely 2 dividend payments with the protection in place for an increase in cost, yes, but a better control and less cost per day. But let's think about it this way. In addition to our example, if we looked at the current prices just today, and I know this isn't a great view, I tried to put a lot on the screen, but using the 90 to 100 day approach and the 20% or so protection, if we bought the stock at 45.52 and bought that March 40 put for 208, we're risking 760 or 16% on the position. At the halfway point, you've got a break-even of 47.60. Not too bad, but again, you're taking a 16% risk, and you're likely only crossing one dividend, ex-dividend date. This over here, of course, would be our structure buying the stock today. This would be the Marriott put I would do on CRE today. I'd buy the stock at 45.52, buy that 50 put for 8.15. The time value is only 367, my true risk, or 6.8%. And that's for 210 days, potentially going across 2 dividend payments, okay? But which might only be 1% or so that would help a little bit, but I still have the ability to make other adjustments. Your put is all time value. That's just going to decay. You're going to lose that 208 in the first 90 days. If the stock stayed at the same price, you would lose the full 208 in the first 90 days. Even if I held this position, that my June put, all the way out to March, the time value of 367 might only drop a third of that. I might only lose $1.20 or $1.30. I'm not going to lose the full 208 because it's going to decay more slowly. That's making a broad assumption that volatility, price, and everything remains about the same, but at the same time, that's the advantage we get with a further out strike put option. Okay, so those are just some of the comparisons. In relation to the two, think the 16 is too high. And why is a percentage that high? And Sam will probably agree with this. He said 16 is too much too. I like to keep it 7 to 8. So do I, and here's the reason why. The way the math works. Gambler's ruin. You take a 10% loss. You invest $10,000 into a stock. You lose $1,000. You're left with $9,000. Okay? Do you need a 10% gain to get back to break even? No. 10% on $9,000 would only put you at $9,900. Okay, you're pretty close, but you actually need an 11.1% gain to get back to break even. If you take a 20% loss, you'd need a 25% gain on what you have left to get back to break even. You lose a third, 10,000 drops to 6,700. Well, I need half of that, right? I need $3,400 to get back to 10,000. That's a 50% gain on what I have remaining. Of course, you take a 50% loss, you need 100% to get back to break even. Why do I like the lower risk in the single digits? Because if I take a 5% loss, I only need a 5.3% gain to get back to break even. So think about that. Even with a 10% loss that I was taking, I think is maybe too high. How often over that 90-day period with dividend payment and increase in stocks do you see an 11 or 12% gain? In some markets you will. Are you seeing that consistently? If not, the 10% risk might be too high. But again, if you're taking that 20% loss, you're allowing that to happen. You take 1 or 2 of those over the 40, 30 positions that you have. How often do you see a 25% gain with dividend and with stock appreciation in a 90 to 100-day period? It's rather tough, especially on a stock that pays a dividend. So that's why we want to keep it in this range, that 3 to 8%, 3 to 9%, 7 to 8%, as Sam says. That's sort of where Ernie's wheelhouse is, for lack of a better term as well. He'll take around the 7 to 8% risk. Now, sure, paying more up front, not necessarily time value, but intrinsic value, does increase the break even. But remember, my position is not all time value. Even if the stock stayed the same with that 50 strike put I bought, I'm guaranteed to get $4 or so back from that, from the intrinsic value. I'm not risking that full 815. It was only about 370, 365. Okay? In any case, that's one reason why we think it is too high. And Sam adds, if the company stops paying a dividend. That's true too. Then I assume that Terrie and Cliff, if that happened, they'd probably get out of that position at that time, or wait till expiration on the short call if they were selling it, just to exit the position because it doesn't match their trading plan going forward. That would be my guess, Sam. All right, now, why more time? Well, I already mentioned one portion of it, that you look at anything. We looked at CRE. If we compared that 40 strike out of the money put that we showed, that was protecting 80% of your value but still taking a 20% risk, the option that was further out in time, twice the amount of time, wouldn't have been twice the cost. The option that's 6 months further out in time, let's say we went to January, a year out in time on CRE, from the 90 days we were looking at in March, it's about 101, 102 days, I believe. But if we went further out to January, to 300 days, almost triple the time, it wouldn't be triple the cost. It might not even be double the cost. But another factor that comes into play is the time decay curve. Okay? Naturally, we know we all want to be selling in this range. We want to be selling shorter term to get the time value decay rapid in our favor. But buying 30 days out, buying 60 days out, you start to hit that curve quickly. You start to get that decay quickly. And if the stock's not moving in the direction you anticipated, something came out in the market which pushed the market in the opposite direction of your trade, then you start to see more of this rapid time decay. 120 to 90 days, still pretty good for the 90, about half the time, and then it just starts to fall. But if I'm 150 days out, 200 days out in time, I have a very slow time decay, assuming all things stay the same, but a very slow time decay for the first 30 to 60 days to 90 days, with still another 90 to 100 days to go. Okay, so that's just one of the things we want to put in our favor. Lower cost per day, less time decay against us. That's why we go at least 150 days out in time. And another core principle of radioactive trading we follow is why we're buying it in the money, to control that risk better, as we mentioned, instead of risking that 15, 19, 20%. But to the real main question, now that we spent 15, 20 minutes here on that, the real main question, though, is the risk of selling a call. Look at the structure. Here's the CRE position. Using that out-of-the-money put 90 days, 100 days away for that cheap cost of $2.08. Doesn't add much to our cost basis. However, we're taking a 20% risk. We sell near term. We sell even out of the money, not at the money. I wouldn't be selling the 45 here. I'd be going out of the money to the December 47.5. And this looks amazing. I'm collecting more than half of the cost of that put on this new call. But what's the trade-off? Okay, I take my risk down from that 19% down to 17.3. But the peak of the profit is right here, and that's only at 0.7%. That's not really worth it. I'm sure you might be going out to January. You might be looking at a higher strike in this case. And that's I'm sorry, not a higher strike, further out in time to get more premium in this case. But a 0.7% return on a 34-cent maximum profit, I don't think that's going to be worth it. But you can see here, I'm sorry, my little tablet they give me here, a GoToMeeting got squirrely. There we go. Perfect. It's a very low potential return, a very low trail. Sure, you decreased your risk by about 1%, 1.8% to get a max at 0.7, and you've got an upper and lower break even due to the structure of this trade. Your window is very small of profit. So this is where Sam's thought comes in. What I would say maybe a different way, but Sam says you have to pay attention to support versus, yes, the stock is down here and you're trying to hedge some of the loss, you're trying to get premium. And if the stock stays below 47.5, sure, you're better selling this December 47.5 call than not doing it. But if you think it's hit this point and you're adding protection now, you had a naked put, the stock fell and you got a sign, but you think it's going to recover, why handicap yourself in this case? Wait for the stock to recover, and what you're waiting for is where you think the stock has hit its upper level. Sam would say support and resistance. We think it's hit its upper level and it's going to stagnate or maybe pull back. That's when you sell a call. You maximize the premium at the peak to have it fall. Now, of course, some of you I know are just doing covered calls because you're not married to the stock. You just buy a stock every Monday for a weekly and you sell an at-the-money call against it. You want to be assigned to make the return and just go into the next week. Different approach. Same strategy, sort of. Different approach. You're looking to be assigned. Terrie and Cliff are not. And that's the risk with selling the call, because you're actually saying when you sell that call, you're not expecting the stock to go up anymore. You want it to stay right around this peak. You probably don't want it to go more than 47.75, 47.80, somewhere in that range. So it might only cost you a fifth of what you collected to buy it back and then look to roll another call. Now, of course, that might be one of your triggers. But if your trigger hits 2 days after you open this position, this is probably going to cost you $2 to buy it back. And now you're adding into this cost basis, which adds into this risk. Selling a call does create a neutral. And this, when you want to hold the stock long term to collect dividends, selling the call means that you're neutral to slightly bearish. You're expecting the stock to stay where it is or fall a little bit. You're not expecting it to move above that short call strike price. If you have that expectation, maybe don't sell the call. Maybe go out another month and look for a higher strike, or wait. Wait until the stock moves up, hits the peak, and then you see the stock start to slow down. You've got the put in place, but I'd like to see a better put for you. And that's when you sell the call. When you're at the peak and you think it's run out of steam and it's going to pull back, that's the best time to sell the call. Doesn't mean you can't do anything in this situation. That's not true at all. Just like a covered call, if I wanted to hold the stock long term, if CRE now started to creep up to 47, 47.25, 47.70, I'm going to be tempted to buy to close this December call back, and I may be looking to go out to January at the 50 strike. Or if there's weekly options, go out another 2 weeks, January 1st cycle, first week of 2020, and might go up a higher level to, let's say, the 48 or the 49, depending on where I think the stock is going. Right? I don't want the stock to hit the strike price. So if it goes ITM, there are options to roll. Treat it as you would any covered call. You could roll the call up or you could roll the call down. It's likely going to cost you a debit. What I don't advise Terrie and Cliff ever to do is, let's say that we're in that position. Let me go back one. I know it's, oops, sorry folks. I know it goes back one. Well, let's say we hit December here and the stock's at 49. Sorry folks, wrong click. The stock's at 49. Oh, thank you. The stock's at 49. Well, it's going to cost me $1.60, $1.70 to buy this back, so I'm 70 cents in the hole. Now let's say the January 50 is not offering that much premium for whatever reason. There's not a February series yet, but there's a June series. So I buy to close my December call for a couple dollars, and I sell a June, or maybe I'm even worried about the 50, so I want to go to 50.5. I sell a June 52.5 for $1.20. You never want to put the short call at an expiration beyond the long put. Sure, it looks like a great premium, but now what happens? Well, you got to say in March, if this ends, if you still want to protect this, you've got to buy another put that's out to June or to August. What's that going to do? Increase everything and take away from the maximum profit that you just achieved. You want to keep it at the same. You don't want to roll the short call past the long put. There's investors out there I know who teach that strategy. I don't want to call it a reverse collar. I consider that something else. But they teach selling a call that's 6 months out in time and buying a put that's only 3 months out in time. And as the stock moves, hey, you can buy the call back cheaper. Well, no. It's 6 months out. You're not going to see the time decay until the last 2 months. You're already past your put expiration. You're going to have to add an extra put in that equation, and that's really going to come back and haunt you potentially, because what? What you originally saw on your reverse collar, let's call it that looked like a good profit up here of 4% and a thing here, but a potential profit down here in the short term because the way the math works, well, that's only good for that first cycle. If you want to stay in the position and this hasn't decayed enough yet for you, you can't buy it back because you're looking at a 0.5% return for a 4-month, 3-month position. That's not in your trading plan. That's not what you were looking for. So now you got to extend it. So you got to buy another put, and that does what? That lowers everything. So the max profit here might only be 1. And this might go up to a risk of 8%. I don't feel it's a good structured trade, personally. I think it goes against one of the caveat of options trading, which we already saw. You want to sell near term and buy long term for the lower cost per day. Doing it in the reverse, buying that near term put and selling a 6 to 8 month out call, you're denying you're lowering your income per day and you're increasing your cost per day. It just seems backwards. All right. So let's move on from that. You can roll the call up, but it's going to cost a debit, which might increase your risk. In the blueprint, the home study kit you have, Terrie and Cliff, the first income method number 1, talks about what we look for to sell the call in our preferred structure. The next chapter, income method number 2, discusses how to roll the position, the best approach to roll that short call once it goes in the money, what you want to look for, and more. Of course, there's a total of 12 income methods to do in the protected married put structure in our fashion because of the structure that we use with the in-the-money put. Harder to do with the out-of-the-money put because you're losing time value in that situation. We both are losing time value, but the in-the-money option can actually see an increase in extrinsic value if it goes from in-the-money to at-the-money. The long, your other put might too, but that means it's fallen another 7, 8 points and has dropped down to where you didn't want it to. If ours goes up on the bullish trade, yes, you're going to lose intrinsic, but you're going to see a swelling of extrinsic value, and we can swap that to actually get better profit. But let's take a look at how another tool will help you. I'm going to pause the screen. I'm going to manually say that I'm pausing the screen, so I remind myself to unpause the screen. There you go. And we're looking at the PowerOptions tools right now. And so Terrie and Cliff, what I wanted to show you here is that, of course, we were looking at some of the values earlier today. I was putting them into the portfolio. Our 100 shares of CRE at 47.35, converted it to the 2 married puts, the one out to June, which is 210 days away. And I'm sorry, March was 119 days away, not 102. But then I went ahead and added the collar, which you would have seen there. That's how I got the profit and loss chart. But I added another position in too. And this is similar to the collar that we were just talking about. A little bit different structure, but very similar. And as I'm tracking this in the portfolio, I've sold the December 52.5 call, and the stock's now at 53.61. So I'm probably wanting to do something with this position. I set my alert so it's triggered, and it would have emailed me saying your stock is above your price of 52.95, so you might need to consider managing this trade. So I'll go into the portfolio once I have it added. I'll go to position actions and then position analysis. This is going to give us a breakdown of this collar. So what I did is assume that back on 11/1 I bought shares at I bought shares at 51.50, bought the April 52.5 put, and sold the December 52.5 put for $1.05. Let me refresh the page. I think I moved it too soon and it didn't there we go. So this is a collar. Structure I don't like. Some of you already know why. I wouldn't do this trade, but we're using it as an example. I don't like to enter collars in this type of situation that have an upper and lower break even. I want to see something that's more smooth, even if it means more risk. Well, it wouldn't go back up like that, but that doesn't go back into the red zone. I want to have a structure here where I still have a possible potential return, 1, 2, 3% to the upside. Risk is lowering from where I initially started from the premium, but it doesn't go back into the red. I don't want that. But that was a similar structure we would have seen following the 90 to 100 day put we were discussing, with out of the money to protect only 80% of it, leaving 20% at risk. Sold it too soon, too low of a strike price, I think as Sam just mentioned in that case, and that's why we want to do it there as well. Okay. All right. So why am I showing you this tool? Because if I scroll down below, it tells me where I am now. My original expected return was 2.6%. If I liquidate right now, I'm at a loss of 1.3. I don't want that. Stock stays around the same price to December, I'm going to make 1.8. Why? because it's above the short call. I'm going to have to pay to buy that back or get assigned at the lower price and sell the put. I'm not going to make the 2.6%. That occurs only at 52.5. We're already at 53.61. But down below, we see some calculated adjustments for us. And right here, we do see, of course, that we could, price of the stock went over the strike price. We could consider using income method number 2 to roll up the call. We can buy our call back for $3.40. Eesh, only collected $1.08 for it. We got to pay $3.40. But going out to December, going higher in December, I could get $1.95. Shows you the call premium. We could go to January and get $2.45. And then it shows me the new potential return if assigned, so I could make 2.6% here at 55 on either strike, and the probability, the annualized assign, and more. And yes, I could roll out to April, but now I'm risking that because the put's in April. I don't want to go further than April because my put's in April. I want to keep sort of in this range. Now, that's all well and good. It's good to see things numerically, but one of the advantages of these tools, I want to see what roles are available. I don't want to do the math myself. I can just use the more information button next to the preferred position and go to simulate trade. And this gives us a side-by-side comparison of what we're looking at right now. Is this a good trade? It's tough to say. Your original position over here on the left was a risk of 5.1% with a potential return of 2.6, but we're at a loss right now of 1.7. That's key. Rolling this position, I can turn a 1.7% loss to 2.6 if this trend continues and goes up to 55, but I have to accept an increase in risk because I'm going to be rolling for a debit. The original 105 plus the new 195 I get puts me at 295, but it's going to cost me 340. So I am rolling for a debit in this case, but what I could do also is probably adjust this put and lower that risk at the same time. That would be what we call income method number 4. So that's just an easy way to evaluate your rollouts. If you're tracking multiple positions in this fashion, when you've sold the call, you can enter, you can enter the collar into the portfolio and then set alerts to be notified when the stock goes above your strike. Go to that more information button, the position actions and position analysis, and it'll show you rollout opportunities that are available on your position. I think Sam just says, when he does his short-term positions on SPY, he sells SPY calls, but his cost is $2.11, so he's a much lower cost basis right now. You need to buy back very low so you collect the dividends, and if I lose on my calls, it'll be 50 cents, not a full amount. And he says, I sold the 312 long-term because 311 is a short-term resistance. The SPY dropped from 312 2 days ago, so that goes along his trends of following the support and resistance when deciding to sell a call or even sell a put, depending on the structure that he's using. And that's what a lot of investors do as well.